that candle, the closing price, what that's denoting is the distinction between where we closed for the 1 hour break and when we opened back up at 6 o'clock. So it's very little change. In fact, it's only one tick. While it might not look that important, but this is a new day gap opening, abbreviated by NDOG. New week opening gap is where we have the difference between where we closed on the previous week's Friday and the new Sunday's opening. New day opening gap is the difference between where we close at 5 p.m. New York local time and where we open at 6 p.m. New York local time. Going over here, you can see, look at the bodies are respecting it here. Look at the candle high here. A lot of sensitivity around there. So if you scrub forward, here we are at new day opening gap. And the only thing I really highlighted here was the 7 o'clock time where, like if you're trading forex, you can trade forex around 7 o'clock to 9 o'clock in the morning New York local time. If I suspect, this is where you're supposed to be taking notes, if I suspect that the market's going to be problematic for me, meaning that it's either going to be very hard to read, and I'm expecting that because of some news driver that would come the next day or later in the afternoon, like FOMC, I will adopt the 7 o'clock to 8:30 time window if I want to trade pre-market. So before 8:30 news driver comes, if I see something that I want to participate in, and I think that the news driver at 8:30, what I mean by news driver, any kind of report data, some kind of market medium impact or high impact news event that usually gets released around 8:30 New York local time. If I like the market structure that's in play at 7 o'clock going into 8:30, I have no fear of getting in a trade and using the 8:30 hour to roll right into my targets. So this level here, that's the consequent encroachment of a previous new week opening gap. The market ran aggressively right to that. When did this run occur? Going into what? The 7 o'clock hour. This whole run right here, right to that price point, set the stage for me to trust that I could find a setup before the 9:30 opening. And I had already anticipated that the 9:30 opening and throughout the session today would be lethargic, choppy, range bound. I don't prefer to trade in those environments. So because I saw this morning and it started to break down, I was watching the low of the previous week's new week opening gap. So when we ran up to new day opening gap here, which again is, for your notes, the closing price at 5 p.m. and then the new opening price at 6 p.m. That hour gap that futures have every single day in the evening time in New York local time, that difference, whatever that range difference is, it could be several handles or it could be one tick, just like this. You want to have that annotated on your chart throughout the day. It's a reference point that the algorithm will refer back to. But that new day opening gap, it ran to that quickly. Would you agree that that was a real quick run up into that? It's occurring at that 7 o'clock hour, New York local time. So 7 o'clock in the morning to 8:30. If there's going to be a difficult time in trading, if I think that we're going to consolidate or we're in low probability conditions, that means that I'm probably going to be taking something before 8:30. So I looked for the market to move away from the new day opening gap, which it did. I waited for it to trade down to the low of the previous week's new week opening gap. If you look at the move away from the new week opening gap's low, we had displacement to the downside. I wanted to see it trade back to this key level, which is the previous week's new week opening gap. Then I waited for what? Displacement. I want to see it move sharply away from it. Then, because it did that, what happens? We have a fair value gap right here. So that fair value gap and the last up close candle at the new week opening gap. Which order blocks do you use, ICT? You're learning. There's multiple things about this. It's not just the last up close candle before the drop. It's where you're at when that candle forms. When we're looking for order blocks, that change in the state of delivery, which is what an order block is, it's not the candle. It has absolutely nothing to do with the candle. It's the change in the state of delivery. The market changes the state of delivery right here. Once it starts delivering sell side and you have a fair value gap, your eye goes right back to that opening price. It's going to trade up into the fair value gap. That's where you want to try to take your entry. You allow for the price to trade up to that level because if it does, then you do another entry there as well. If you hold out the trade to the order block and don't put anything on inside the fair value gap, sometimes the order block will not be traded to. The fair value gap will be the only respected level, and then it runs away. And then you have to use a lower, closer proximity entry to a price point that's lower than the key ideal entry points like this one here. So the market moves again, small little movement into this candle's high. I like that. And then we had this fair value gap that formed. What kind of fair value gap is this? SIBI. sell side imbalance, buy side inefficiency. I wanted to see this remain open, and the market moved lower and attacked the sell side in here. All of this setting up for what? A move going into 8:30. Once I know I'm looking for a run, then I'm expecting that 8:30 hour. If I know that the day that I'm about to trade is going to be a range bound consolidation day or just choppy, I'm going to be doing my work between 7 o'clock and 8:30.